Welcome to the Daily MBA, where business wisdom is served fresh and fast, straight from one of the top MBA programs in the world. I'll give you summaries of my lectures and readings, as well as the most important insights gained from an MBA, so you can apply all of this knowledge in every business. Let's get started. On today's episode, we're going to go back into finance. But now we're not going to talk about personal finance, stocks, bonds, because we already know all of that from my previous episodes. What we're going to start focusing on now is going to be corporate finance. And so what is the difference between corporate finance and the other type of finance that we were doing before? Basically, corporate finance is going to start mixing all of the concepts that we already saw around valuation and financing, but we're going to mix those with accounting, because that's what corporations do. All the time, you are mixing all of them. So corporate finance, basically, I'm going to do this super brief introduction, is always going to be aiming to make three decisions. The first decision is going to be an investment decision. So this is, how do I use my money? This is related to what we already learned before, but when we look at it into the corporate finance perspective, it will be known as capital budgeting. So remember, in my previous episodes, I told you everything with finance comes with a jargon. Here, every time that someone is talking about capital budgeting, this is going to be regarding their investment decisions. So where are they going to put their money into? Second decision is going to be financing decisions. And financing decisions is going to be, how will we raise the money for paying those investments? And so this is going to also have a specific name, and it's going to be called the capital structure. And if you remember, there are two ways of raising money. You can raise it through equity, or you can raise it through debt. And then this, if we also look back into accounting, should always match our assets, right? Because we're going to get assets, but the way we pay for them may be either equity or debt. So financing decisions are always going to be revolving around this financial mix and how much equity or debt are we going to raise. The last and third decision that corporate finance wants to answer is all of the payout. So when and how are we going to return the money back to our investors? Whether this was a bank or whether this was for equity. So summarizing, very simple, three decisions: investment decisions, financing decisions, and payout decisions. And all of this is going to summarize most of the money decisions that every company is paying. So every CFO is making all of those decisions, which are going to be, how do we use the money, how do we raise the money, and how do we pay back and return that money? All right, so this is very simple, but I also want you to take a little bit of a deeper dive into this, and it's, why do these decisions matter for us? Maybe you might think, oh, I don't care about finance, but this is going way beyond this, because there's a very interesting theory that states that for distributing wealth, which is the ultimate goal of any government or any company as well, you want to be distributing this wealth, you first need to grow. And for growth to happen, you need to invest. So this becomes like a virtuous cycle, because all of these decisions, when made properly, should make that new investments are going to lead to an enhanced quality of life. And how is this going to work? Basically, because if you invest, your company will grow. And if you're able to grow, you will be able to distribute this money. If you don't have the growth, you won't be able to distribute any wealth, because you don't have anywhere to take that money from. And so you can't grow if you are not doing anything new. If you're just doing business as usual, this is not going to lead you to grow. So this is going to be driving most of the companies nowadays, and especially those that are in Wall Street or big companies that are already in the stock market, because we're always looking for that. Investments that will lead to growth and then will lead to distributions. So that's either dividend payout or just growth that will lead to other types of payout for employees, etc. So as a starting point, I also want to tell you a second thing that is going to be very important in corporate finance, and it's going to be regarding our purpose as a company. There is a big debate on this, and if you have any other opinion, you can drop it in the comments and we can start chatting about it. But most of the economic theory states that a firm's goal should be to maximize shareholders' value. That's it. And so this may not sound well intuitively at first. Firms, of course, have other goals rather than just maximizing the shareholder value or the dollar value, let's say. But we have to consider that most of these things are going to be what's going to lead to the future of the company. So let's say, for example, my company also has a sustainable vision. I want to be eco-friendly. I want to help the planet. Why do I want to do that? Because it will maybe bring more customers, or I'm doing something good to the planet. And why do I want to do that? If I have more customers, I have more profit. And if I'm taking care of the planet, I'll be able to stay in operations for longer. And so therefore, the last thing that you're aiming is to maximize the shareholder value. Because if you're not maximizing the shareholder value, then technically the shareholders or the owners wouldn't be working on the first hand. So this is going to sound a little too broad, but it's going to be the baseline for all of the corporate finance decisions that we're going to make. And so even though this may be simplifying it a lot, you have to consider that in the real world, when you're standing in the board of directors, there are going to be lots of people with different agendas, and this unique goal is one that is unifying all of them. So it's one of the things that we can consider when setting goals into the future. Also, second thing that you should consider is that maximizing shareholder value doesn't mean maximizing it right now. It would mean that we're maximizing it in a long-term view. So here we're talking about the future cash flows, not right now. And that's why all of these decisions may ultimately will lead to maximizing the shareholder value. Because, for example, let's say another purpose of a company might be keep employees happy. If you're keeping them happy, they're going to stay longer in the company. They're going to be productive. So right now, they are going to cost you more. But what this leads is that the future outcome of the future cash flows is going to be increased because you're going to have all of this production that will lead to more output and therefore more value for its shareholders. So if you think about it, every possible objective that a company may have will, in the future, also have value, economic value, let's say, in the cash flows for its shareholders. So considering these two things in mind, first, the three types of financing decisions, and then second, the company's goal, we're going to start diving deeper into corporate finance. And in my next episode, I'm going to start explaining everything around the first decision, that it's investment decision or capital budgeting, so you can start knowing how to use your money when you are in a corporation. I'll see you next week.